Current trading data indicates that Supermicro Computer Inc. is changing hands right now at $34.64, representing a decline of approximately 26 cents or 0.73% for the intraday session. While a movement of less than 1% might appear pedestrian on a typical Tuesday morning, the reality of this stock chart is anything but ordinary. What you are witnessing at this precise moment is the deceptive calm following one of the most violent, vertical upward repricing events in recent market history. The expectation from the broader financial community, and certainly from the legion of short sellers who had piled into this trade, was that Supermicro Computer was effectively a dead company walking, destined for an immediate delisting from the Nasdaq exchange and a relegation to the over-the-counter pink sheets. The narrative was set in stone. The auditor had resigned, trust was broken, and the filing deadline was impossible to meet. Then came the reality check that blew those expectations out of the water. Late yesterday, the company announced they had secured a new auditor and filed a compliance plan, sending the stock soaring nearly 40% in a single session. Today's price action, this minor red candle you are seeing on your screen, is simply the market digesting that massive influx of information, consolidating gains, and asking the next critical question: is the danger actually over, or has it merely been postponed? When you look at the recent history of this ticker, you are looking at a battleground that highlights the extreme psychological gap between institutional fear and retail opportunity. The sheer volume of shares traded in the last 24 hours suggests a capitulation of the bear thesis that had dominated the stock for months. Investors who utilize platforms like Interactive Brokers trading interfaces or the Fidelity mobile app have likely seen the hard-to-borrow warnings flashing on this stock for weeks. The expectation was that without an auditor, specifically after the dramatic exit of Ernst & Young, the company would have no mechanism to verify its financials. The reality, however, is that the appointment of BDO USA as the independent auditor provides a technical validation that keeps the company in the game. This does not mean the accounting issues are solved, but it means the referee is back on the field, allowing the game to continue. This specific development is what triggered the massive squeeze we saw yesterday and explains the tentative holding pattern we are seeing today at the $34 level. To understand the gravity of this situation, we have to look beyond just the price and look at the mechanics of what is happening with the Nasdaq listing requirements. For those of you engaging in self-investing or managing your own capital through an individual brokerage, these listing rules can often seem like bureaucratic noise. But here they are the difference between a stock being marginable and widely traded or being cast into the liquidity desert of the unlisted markets. Supermicro had until Monday to submit a plan. The expectation was that they might ask for an extension without a solid plan, or worse, failed to submit anything substantial. The reality was a concrete filing that included the engagement of BDO, a top-tier firm outside of the Big Four, which immediately substantiated their claim that they are working to rectify the delayed filings. This news catalyzed a rush of buying pressure that overwhelmed the order books on nearly every major execution venue, from Robinhood stock trading dashboards to the more complex algorithmic desks using Interactive Brokers platform connections. The volatility we are seeing is also heavily correlated with the broader semiconductor sector, specifically the movement of NVIDIA stock. You cannot talk about Supermicro without talking about NVIDIA. The expectation is that Supermicro is just a box mover, a low-margin assembler of commodity hardware. The reality, which tech-savvy investors realize, is that they are the primary vessel for NVIDIA's most advanced chips, specifically the Blackwell architecture. Supermicro's proprietary liquid cooling technology is not just a nice-to-have feature, it is an engineering necessity for these new, incredibly hot-running AI chips. When NVIDIA stock moves, it often drags SMCI with it, but right now SMCI is trading on its own idiosyncratic risk factors. While Apple stock and Tesla stock often trade on consumer sentiment and macro trends, Supermicro is currently trading almost entirely on governance credibility. The market is trying to price in the trust discount. How much is a company worth if its sales are growing triple digits, but you're not 100% sure about the timing of the revenue recognition? That is the multi-billion-dollar question keeping traders glued to their SoFi active investing screens. Let's pause on the retail sentiment for a moment. If you look at the discussion boards and the flow of orders coming through Robinhood app and SoFi Stocks chats, there is a clear divide. On one side, you have the value hunters, who see a company trading at a single-digit forward price-to-earnings ratio, a valuation that is unheard of for a company growing at this speed. These investors are using investing sites and investment help forums to validate their thesis that the accounting issues are temporary growing pains. On the other hand, you have the governance hawks, often older investors, perhaps managing money through Fidelity Wealth Management or Schwab Intelligent Portfolios, who refuse to touch a company with auditor resignations regardless of the growth rate. This clash is what creates the liquidity and the volatility. When you decide to invest online, particularly in a name like this, you are stepping into the crossfire of these two diametrically opposed philosophies. One side says, growth at all costs. The other says, accounting integrity is everything. The appointment of BDO is a critical pivot point. While they are not a Big Four firm like Deloitte, PwC, EY, or KPMG, BDO is the next best thing, a massive global network with the resources to handle a company of Supermicro's size. The fact that BDO accepted the engagement is a signal in itself. Audit firms are incredibly risk-averse. The expectation was that Supermicro was unauditable because E&Y left, citing that they could no longer rely on representations from management. The reality that BDO stepped in suggests that they performed their own due diligence and decided the risk was manageable. This discrepancy between the unauditable narrative and the hired new auditor reality is where the alpha was generated yesterday. It forces the market to re-rate the probability of fraud. If BDO is willing to sign off, the likelihood of a catastrophic Enron-style collapse decreases significantly, even if it doesn't disappear entirely. This creates a massive repricing of the risk premium, which is why we saw the stock explode from the mid-20s to the mid-30s in the blink of an eye. Now, let's look at the business itself stripped of the accounting drama. Supermicro Computer is, in many ways, the physical builder of the AI infrastructure. They take the silicon brains from NVIDIA, AMD, and Intel, and they build the bodies, the server racks, the cooling systems, the power supplies. Their building block architecture allows them to assemble customized servers faster than competitors, like Dell or HPE. This speed is their critical advantage. In the AI race, being weeks or months faster to market is worth billions. When a hyperscaler wants to deploy 10,000 H100 GPUs, they don't want to wait 6 months for the servers, they want them yesterday. Supermicro's ability to deliver these rack-scale plug-and-play solutions has made them a favorite in Silicon Valley. However, this rapid growth is likely what broke their internal controls. Scaling revenue from a few billion to over 10 billion in a short time frame puts immense pressure on finance teams, internal auditors, and supply chain managers. The reality of their operations outpaced the expectation of their back-office maturity. As we analyze the intraday action today, the slight pullback to $34.64 is healthy. A stock cannot go up 40% in a straight line without some profit-taking. Traders who bought the dip in the teens using their Robinhood cash management funds or SoFi robo-advisor allocated capital are likely taking some chips off the table. This selling pressure is meeting buying pressure from institutions who are waiting for the auditor news to step back in. We are seeing a handoff from the high-risk speculators to the slightly more conservative momentum traders. The volume remains elevated, which indicates that the story is far from over. If you track institutional flows through Fidelity brokerage data or Interactive Brokers stock trading reports, you will likely see that the smart money is cautiously dipping a toe back in, but they are waiting for the Nasdaq to officially accept the compliance plan before fully committing. Speaking of Nasdaq, let's clarify the regulatory timeline. The filing of the plan stops the clock. Nasdaq now has to review the plan, which could take weeks. If they accept it, Supermicro will be granted a specific time frame, usually 180 days, to file their missing 10K and 10Q reports. This buys the company time. The expectation was a hard stop. The reality is an extension. This extension allows the company to focus on the audit without the daily threat of the ticker symbol disappearing. For those of you holding Fidelity ETFs or Fidelity mutual funds that track the Russell 2000 or the S&P 500, this matters because SMCI is a constituent. If it were to be delisted, it would force forced selling by these passive funds, creating a massive downside shock. The avoidance of immediate delisting prevents this forced liquidation spiral, which acts as a floor for the stock price in the near term. I want you to take a moment and think about your own risk tolerance. Comment